$30,000 in unexpected taxes just landed on your April filing, and your advisor's 1035 exchange is the reason. Your old life insurance policy had $75,000 in accumulated cash value. You thought the swap to a new contract was tax-free. The IRS disagrees on one technicality nobody warned you about. Here's the belief most high-income professionals hold. A 1035 exchange is a rubber stamp IRS process. You swap one life insurance policy for another, and the exchange is automatically tax-free. No compliance burden, no hidden landmines. Simple. That's wrong. IRC Section 1035A does permit tax-free exchanges, but only if you follow a precise three-step sequence. The research shows that advisors routinely miss one hidden rule inside Treasury Regulation 1035-1, and when they do, the entire accumulated cash value becomes immediately taxable as ordinary income. Let me show you the math. Assume you have a $250,000 life insurance policy with $75,000 in accumulated cash value. The gain is $75,000. If that exchange fails because of a compliance error, that entire $75,000 becomes taxable income in the year of the mistake. For a household in the 37% federal tax bracket plus 8% net investment income tax, the federal liability alone is approximately $30,000. Add state income tax, assume 5%, and you're looking at $33,750 in total unexpected tax liability. The delta between a compliant exchange, tax $0, and a botched exchange is $33,750 plus. That's the hidden trap. Now, here's what the IRS actually requires, and what most advisors don't explain. First, both the old contract and the new contract must be issued by insurance companies, not a brokerage, not a third-party administrator, the insurance company directly. Second, the exchange must occur in a single transaction. No interim receipt of cash, no lapse in coverage, no break in the chain. If you receive even $1 in cash during the exchange process, the entire transaction collapses and the full cash value becomes taxable. Third, the new contract must be received in exchange for the old one. Treasury Regulation 1035-1 specifies that the taxpayer must not have dominion over the cash value between the surrender and the new issuance. The moment you touch the money, the exchange fails. According to IRS guidance and tax court case law, the most common failure point is a timing gap. The old policy lapses or is surrendered before the new policy is issued. The IRS treats this as a taxable event because the policyholder was, even momentarily, without coverage and without a qualifying exchange vehicle. The second failure point is a misunderstanding about what exchange means. Some advisors think you can take a distribution from the old policy, receive the cash, and then purchase a new policy. That's not a 1035 exchange. That's a full surrender and a new purchase, and the $75,000 gain is taxed as ordinary income in the year of surrender. So who bears the risk if this fails? Typically, the policyholder. The advisor may have recommended the repositioning, but once the transaction is executed, you own the tax liability. The insurance company processes what it's told to process. The advisor may argue they gave general guidance, not tax advice, and you're left explaining a $30,000 plus bill to your CPA. The solution is simple. Before any 1035 exchange, require a written acknowledgement from your insurance agent confirming the following. 1. Both contracts are issued by licensed insurance companies. 2. The exchange will occur in a single, continuous transaction with no interim cash receipt. 3. The new contract will be issued before or simultaneously with the surrender of the old contract. 4. There will be no lapse in coverage. And 5. The exchange will comply with Treasury Regulation 1035-1. If your advisor cannot provide this in writing, do not proceed. The tax code permits 1035 exchanges, but it rewards precision. If you have a $250K plus life insurance policy and you're considering repositioning, this is not a decision to rush. Get a licensed tax professional to review the exchange sequence before you sign. The cost of a 1-hour consultation is negligible compared to the $30,000 plus risk of a failed exchange. The tax code rewards those who study it.